What's up guys, welcome back. This is Lucas from IntraAlpha, and on today's video we're going to be talking about the risks associated with trading options. That means if you're buying or you're selling, what can go wrong, what should you be looking out for, and how can you avoid those portfolio killing losses. If you are new to option trading or you can't figure out why you keep blowing up your account, then this video is for you. First of all, relative to other financial assets, options are probably the most complex and nuanced instrument in the entire market. So don't feel bad if you're struggling to understand them or you find yourself running into issues while you're trading them. There's a lot to learn, there's a lot to figure out, and unfortunately, there's a lot that can go wrong. This type of complexity shows up in a lot of different ways, and on this video we're going to break down what each of those ways are and what to look out for, and most importantly, how you can avoid them. When you talk about risk for an option seller, you're actually talking about a potential reward for an option buyer. So keep that in mind because it depends on what team you're playing for and what color your jersey is. These are either going to hurt you or help you, but if you're going to trade options, you absolutely must know what each and every one of these things are. Alright guys, so first up, let's cover assignment risk. Assignment risk is the risk that is inherent when you sell an option to someone else. You are giving that counterparty the opportunity to either put or call 100 shares. You have no way to avoid this. If your call or put is in the money, that counterparty has the right to exercise and assign those shares to you or call them away, depending on if you have a short call or a short put. If your portfolio does not have the buying power to make good on this obligation, you better be prepared for a margin call, or your broker is going to liquidate other positions so that you have the funds available to buy those 100 shares or short those 100 shares. Keep in mind, this risk only applies to American options. If you are trading European options for some reason or you're in Europe, this really doesn't apply to you because all of those options are held till expiration, so you don't have to worry during the duration of the contract. That duration only applies to American options because those American options can be exercised at any time. For example, if you are long 100 shares and you sold a covered call and now the stock has moved up and that option is now in the money, you run the risk at any moment in time that counterparty exercising their right and calling those 100 shares away from you. You don't know when it will happen, you don't know if it will happen, but the risk is real and there's absolutely nothing you can do about it besides closing that contract. Similarly, put option sellers actually face the other risk. If you sell a put and then the stock price falls and your put is now in the money, you run the risk of waking up one day and seeing a 100 share position in your portfolio. You sold the right to your counterparty, the counterparty exercised, and now voila, you now find yourself with 100 shares of the underlying in your portfolio. Now, the assignment risk is really there at any time that your option is in the money or sort of close to being in the money. And we'll get to those nuances here in a minute, but the important thing to know is you have no control over what your counterparty does. If they want to exercise their option, even if it's out of the money, they could. If they want to exercise when it's close to the money, they could. And if they want to exercise with 100 days left on the contract, they could do that too. So these factors all add up together to put you in a position where as you get closer to being in the money or are in fact in the money, or if you get closer to expiration date, your assignment risk tends to go up. It is more and more profitable and more likely that your counterparty will exercise when you have not very much time left and you are in fact in the money by a large margin. If you're barely in the money or there's a lot of time left, then you don't really face much assignment risk, although it is possible. So how do you know if you're going to be one of the lucky few to get that option contract exercised on you? You actually really don't know. In fact, there is a pool of options and it is a round-robin randomized process at the CBOE for who gets exercised and who does not. So if there's open interest of 100 contracts for a particular option and 3 of those people decide that they want to exercise today and they tell their broker that they are exercising those long puts or long calls, then the CBOE will randomly select those who sold a short option position to that counterparty and assign it to you. It doesn't mean that the exact trader who filled your position is the one that needs to exercise. In fact, it could be any number of traders from all around the world. If your number is called at the CBOE, randomly, you're the one. You're getting exercised on. You either have to buy those 100 shares or you need to sell those 100 shares. But either way, you've been selected. Your time is now. It's time to make good on the promise that you made to your counterparty. You have no way of knowing if you're going to be that person. You have no way of knowing if they're going to randomly select you. However, that risk is always there. Now, the way this plays out is unpredictable. By the time you wake up in the morning and you are the unlucky person either holding the long shares or short 100 shares. Now, in certain situations, this can actually work in your favor. For example, a stock moves big after earnings. The person decides to exercise, and then that move is reversed. You could wake up with 100 shares, and those 100 shares could start moving up in the morning, giving you a 2, 3, or 10% gain on those shares. That might actually have been better than the option that you were holding, but the point of this is you don't know. You don't control it. Therefore, as an option seller, it's a risk. As an option buyer, you actually have the right to exercise whenever you want. But mathematically, it really only makes sense if your option is in the money, and given commissions, slippage, and how much time is remaining, it makes some financial sense to exercise rather than just close the option contract. For the most part, and for most traders, if you have a call option and it goes in the money, you're likely just going to sell and close that call option. If you really want the shares at that price, sure, you could exercise and you'll end up with the shares, but that almost is never more profitable or a smarter decision than simply selling the option contract in the market. Now, if something goes very, very deep in the money, for example, you bought a 100 strike call and all of a sudden the stock is now trading at $200, congratulations, you're sitting on a huge win, but there might not be a market for people who want to buy that 100 call option from you. The person that would buy that $100 call option from you is probably the market maker. For Citadel or Ken Griffin to take that from you, they are going to charge somewhat of a convenience fee to provide that liquidity for you. You could avoid that by simply pushing the exercise button, letting your broker know, and you're going to wake up with those 100 shares at that $100 strike. The other issue with this is you might not have the liquidity to now buy 100 shares at $100, your strike price. So if you don't have that liquidity, you don't have that buying power, you sort of have no choice. You have to sell that option back to the market maker. They're going to provide you the liquidity and life will go on. But again, you're paying a small convenience fee to make that happen. So as an option seller, if you want to mitigate this risk, you basically just need to keep track of which of your options in your portfolio are in the money or close to being in the money. If you've sold those options and they're starting to become threatened and there's not much time left, you might consider just closing them out and taking the L, or maybe it's a win, but you'd rather take that money now than wake up one day and have to be forced to buy or sell those 100 shares. If you're an option buyer, you really don't face this risk. It's your call, what you want to do, but you might want to be monitoring those positions for the same reason. Because if it goes so far in the money, like I said, there might not be a liquid market for you to get out of that position, which may force you to exercise, which is a whole nother can of worms. Up next, we have ex-dividend. The ex-dividend risk only applies to stocks that have dividends. So right away, you've eliminated probably 70 to 80% of stocks in the market who don't pay a dividend. But for those stocks that do, if you sell options on those stocks, that dividend payment is going to move the underlying when it comes out, and folks are going to price that into your option. That just means you're going to sort of gap up or gap down in terms of the underlying, and your option is going to reflect that. Folks might want to exercise their option the day before the ex-dividend date because it makes more financial sense for them to take the 100 shares and own those shares before the ex-dividend date so that they are eligible to receive the dividend. So beware when those ex-dividend dates are coming out It's not when the dividend is paid, it's the date that you need to be the owner of the shares in order to be paid that dividend. When those dates approach, you should be wary of some tricky option prices that move in accordance to the value of that dividend, but also that people are going to either want to own those shares or want to get out of their option position so that they do not have to pay that dividend. That ex-dividend date is going to surprise you, and you're going to wonder, why did this person exercise on me? It's because they wanted the dividend, or they didn't want to pay the dividend. It applies to calls and to puts. If you're an option seller, this is what you're facing. Now, on that ex-dividend date, the stock price is typically adjusted by the amount of the dividend. So if a $100 stock pays a $1 dividend, you're likely going to see that stock move down by the amount of the dividend when it comes out. And the reason this is because if you hold the stock before the ex-dividend date, then you're going to get paid. The reason the stock moves in this way is because before the ex-dividend date, if you hold the shares through the ex-dividend date, you're going to receive the dollar. But if you buy the shares after the ex-dividend date, you're not going to receive that dollar. Therefore, after the ex-dividend date, the stock price typically falls by that same value, $1. If you have sold call options, you're likely going to face this assignment risk because as the ex-dividend date approaches, you have some level of financial incentive to take possession of the shares so that you can get that dividend when they pay it. For that reason, your out of the money call option might actually be in the money financially, and people might want to exercise on you because they want that dividend. You might look like you're in the clear, but if you don't consider that ex-dividend amount and the date, you might wake up and find yourself short those shares because somebody else wanted them. So call sellers and put sellers beware, and call buyers and put option buyers beware, because the stock price is going to move by the value of the dividend, and it might catch you off guard as your contracts move in or out of the money accordingly. Up next, as an option risk, we have what some people call stop hunting. Now, in my personal belief, I don't think this happens too often, and I certainly don't think it has too much of an impact on folks who are only trading one or two shares, one or two option contracts. This really only applies if you have a very large position and you sort of showcase that position in the order book in such a way that market makers and other traders can see it. I know that's a lot of buzzwords, but essentially, if you tell the market that I'm long 100 shares of Apple, but I have a stop for those 100 shares of Apple, 25 cents below the market, then the other traders can actually see that in the order book. And they might decide to try to get you out or force you into liquidating by pushing the stock price down to trigger your stop. When your stop triggers, they will go ahead and buy those shares from you at this depressed value because, in theory, your stop will be a market order and trigger the stock to move down even further, giving them better pricing to buy it. So stop hunting is essentially being able to look in the order book. This is level 2 data. Most retail traders don't even know it exists, and they certainly don't look at it, but institutions and the algorithms absolutely do. So if you put stops in for your option contracts, you might get hunted, in theory, to trigger those stops. They might push the price down to make your broker trigger that order that they are obligated to do, just so that they can come in and buy it. Do I think this applies to the average retail trader? No. Is it a real phenomenon? Maybe. Are there algorithms out there that are actively going around and hunting for stops? Maybe. Does that sort of show up in the time series graph of a particular stock? Yeah, at times it might look that way to you. But the point is that everybody has stops on. The question is that a significant enough signal? Did you tip your hand? When you're playing poker, did you show the other traders what your cards are? And then did those other traders or poker players then make a decision against that? Well, probably not if you're only trading one or two shares or one or two call or put options. It's just not significant enough for them to go after and access those stop orders so that they can sort of conspire against you to take your money. That's a lot of coping in order to deal with a losing trade. It is extremely unlikely and conspiracy theory level to imagine that Ken Griffin and Citadel are out there hunting for you and your stops to punish you for their gain. It's simply not lucrative enough and not real alpha. So how do you avoid this stop hunting? Well, you can simply not put your stops in the book. You can also hide what your orders are and not show them in full to the market. Does Robinhood offer that? No. Do other more sophisticated brokers allow you to do that? Yes. You can put in a block trade for 10,000 shares of Apple at a particular price, but only tell your broker to show the market those shares in 100 share blocks. So the market will never know that you're actually willing to sell 10,000, but after your first 100 is filled, the broker quickly puts out the next 100 and the next 100 and the next 100 until your order is filled. In this way, you can hide what your true stop is or what your true limit order is from the market, and they will never be able to see it or find it. With all that out of the way, let's talk a little bit more about applying stops and limits to option trades specifically. Options are far less liquid, meaning the bid and the ask is far wider on an options contract than it is on an equity share. Oftentimes, equities trade with a 1-cent bid-ask spread. That is as liquid as it could possibly get. Option contracts might trade with a 5 or 10 cent or even wider bid-ask spread. So when you buy a call option for $1 and you put in a stop loss at 80 cents, the question is, what does the 80 cents mean? Is that the mid price? Is that the bid? Is that the ask? Is your stop triggered when your broker sees in the market that the bid for the option contract is 80 cents? Or is it when the mid or when the ask is 80 cents? I'm truly not sure. You'd have to ask your broker. My point is that if you put in a stop loss order for 80 cents on an option contract, don't think you're going to get a fill for 80 cents. What's going to happen is when the criteria is met, your broker is going to hit a market order to get you out. What will you get in terms of a fill on that market order? I'm not sure. Depends on the option contract. It might be 75 cents. It might be 80 cents. It depends on the bid-ask spread at the time and how quickly the market is moving. But stops in general on options are far less reliable. Now, that effect is compounded with multi-leg strategies. So if you have a put credit spread and you actually have 2 legs and you want to say that your stop loss is 80 cents on those 2 legs combined, you now are getting 2 simultaneous market orders. One to get out of the short leg, one to get out of the long leg. When does your broker trigger it? What is the market going to pay you when that order hits the book? It's not clear, but I can almost promise you that it won't be the 80 cents that you expect. What's likely going to happen is the market might be at 85 cents, but your broker knows that you don't want to get any less than 80 cents. So they liquidate you at 85 cents and fill you for 80. Awesome. But maybe you wouldn't actually have wanted that because the market's mid price was 85 cents. So they triggered your stop early. Alternatively, your broker might trigger your order when the mid price is 80. But by the time they get to the market and submit it, the market price to get you out right now is actually 75 cents. So your order triggered at 80, but you got a fill for 75. This is what is very difficult when setting stops and limits for multi-leg option contracts. You're just going to face a lot of slippage, and it's going to be usually more costly than you expect, and those costs always go against you. You're never going to get a fill for higher than you think. It's always going to be worse than you think. Up next, with option trading, you are always going to face relatively illiquid markets. And what I mean by illiquidity is you don't have a high volume of people that are owning or trading or willing to transact on your particular option contract. So say you buy a call option for $1 and the market moves against you. Now that option is trading theoretically for 7 cents. You're finally willing to get out and you go put in an order for 7 cents. But no one's there to take you out because nobody wants that extremely far out of the money call option that only has 2 days left. So what can you do? Drop it to 6 cents? Nobody. 5 cents? Nobody. 4 cents? Nobody. You go refresh your broker and you realize there's an open interest of 1. That's you. You're the only person out there. It's you and your counterparty, the only 2 people in the entire financial universe that is trading that contract. So now you lower it to 3 cents. Finally, market maker shows up and takes it off your hands because they can buy the shares and take your contract and make a spread in between. So they're willing to take you out because you've compromised so much on price that they can make a few cents off you if they buy the shares or sell the shares and either buy your contract or sell your contract. That's what market makers do. They wait for you to move so far away from the fair price of what it is that they can trade with you and make those cents for themselves. That's what illiquidity means, and that's what can happen when you trade options. The inverse is also true. If you buy a stock option for $1 and the stock moves very much in your favor, now that option might be trading for $17 and is super far in the money. That's great. You have an awesome winner on your hands, but unfortunately, the same situation applies. People really don't want to buy a $17 option that's 35 strikes in the money on some particular underlying because it's just not a popular method for trading options. Your option has tremendous intrinsic value, so someone will take it from you, but there isn't a large pool of traders that are getting in and out. So what are you going to do? You try to sell this for $17, what it's worth. Nobody's there. No one's going to buy it from you. So now you drop it to $16.95. No. $16.80. No. $16.75. You finally get a fill. That's when Ken Griffin and Citadel meet you as the market maker to take it off your hands. For the same reason, they know that they can either buy the shares or short the shares and take you out of your position and make that spread. There is an arbitrage opportunity there that basically only they can realize, so they're willing to provide you the liquidity by buying it back from you and giving you the money, and they can make it work out on their end, buying or selling the shares to arbitrage that profit differential away from you. That is the problem with trading options in illiquid markets in general. If you don't have the liquidity, getting in and out is hard. If getting in and out is hard, you will pay the convenience fee for market maker to give you the liquidity that you need. So you might think that you have a 50% winner on your hands. You bought an option for $1 and you sold it for $1.50 in theory, but your entry order that you thought you would get for $1, you actually had to pay $1.04 to get in. And now you see that the option mid price is $1.50. So you think that you have a winner there and you go to sell it. But when you go to sell it, you're only going to get a fill for $1.45. What does that mean? It means you didn't have a 50% winner. You more or less had a 40% winner. What is that 10% that you didn't make? That's slippage. That is the price of illiquidity. That is the convenience fee that you're paying to market maker to get you in and out of the trade. So how do you avoid this? You basically just have to focus on liquid options. There are a handful of stocks, say 100 stocks that are actively traded in terms of option contracts, and they have highly liquid and tremendous volume across the entire option chain. You want to focus on this basket of stocks because with all things held equal, slippage is going to kill you if you try to trade illiquid stocks with illiquid options at a high frequency or a high volume. If you do that over time, you're going to be wondering why your P&L doesn't look so good, even though you keep being correct on direction and on everything else. You have great alpha, you're picking awesome trades, and they're working out in your favor, but you're not being rewarded properly for them because slippage is killing your gains. There's another aspect to this as well. If you end up having a large volume of contracts, say you buy 100 calls, and then this trade works out in your favor, and you now need to get out of 100 calls, but you realize that the market only typically trades 37 of those calls on any given day, If you try to dump 100 of those option contracts on the market with a market order, you are going to move the entire market. Your first 37 might get okay pricing. The next block is going to get inferior pricing. The block after that's going to get even worse pricing until you start sweeping through the entire chain of potential orders where the real humans are happy to get you out. But then you're faced with only the market maker who's there to make a trade with you, but market maker is going to give you terrible pricing to make that happen. If you have too many contracts in a low volume instrument, you're going to move the whole market as you try to trade it. So don't have your position size be so great that you could potentially move the market when you try to get in or get out. You're simply not going to get the price that you think. You're not going to get the price that the broker shows you because that's the mid price right now. When your order hits the book, you're going to delete those people as you get your counterparty to fill you, and you're going to be left with less and less institutions and individuals who are less and less motivated to pay you a fair price. You're going to pay that fee. You're going to move the market against yourself. It's not good. Another option risk that everybody must pay attention to are earnings events and other binary events. If you're an Apple investor, you really want to care about all those Apple product demos and investor days and any major announcement. When they announce the iPhone, it's going to impact your call options or your put options, unfortunately. If you don't track these events, you could wake up one day and be completely surprised that your position's been cut in half and you didn't see it coming. So these binary events can really move the market, which means they can really move your option position. You must pay attention to earnings dates. You must pay attention to macroeconomic events like what the Fed is saying or what major economies are doing geopolitically or militarily. If you don't pay attention, you're just throwing your hands up and saying that you're going to let the market take you wherever it's going to take you and you're going to live with those results. Instead, you should put trades on either before or after those events and anticipate what's coming. So how does this really play out into tangible option risk? Well, implied volatility is typically going to rise as the market anticipates these binary events. So if you know that earnings are coming out in 2 weeks, the market is going to start putting on those calls and those options now leading up until that event, and everything sort of reaches a fever pitch the day before the event. You might have a $100 strike call option and the stock price might trade at $100 for 14 consecutive days, meaning the stock price doesn't move at all and your contract is the same, yet implied volatility will continue to ratchet up as you're leading into earnings, which as an option buyer, you're going to see your option increase in value even though the underlying's not moving. If you're an option seller, you're going to see that option contract start to move against you even though the underlying stock isn't moving. This is an implied volatility surge, an increase as people are more and more willing to pay up for calls and puts to either get a long bet or hedge themselves with a put position for whatever's about to come out on that earnings release. The inverse is also true. Right after the earnings come out, right after the binary event, volatility is going to collapse. Why? Because everybody who placed bets, calls, inputs are now taking their gains or readjusting their position. They're now reallocating their portfolio with this new information that they just got from the earnings report. They don't need those puts. They might not want those calls, but the net result is people are closing option positions. That means they are selling to close those positions. When that happens, you're going to collapse implied volatility. And because implied volatility impacts the price of options, you're going to face some risk. If you buy a call option the day before earnings and you need the stock to move up by 5%, and then the stock moves up by 5%, don't be surprised if you're actually down on that position because your losses on Vega are not enough to be made up by the gains of Delta. That is volatility crush, and it is actually one of the most predictable and tradable things in the options market. So learn this one in and out because it's a risk to some, but it's a reward to others if you know what you're doing. Another option risk that everybody faces is what happens when the equity market is still open, but the options market is closed. As you know, earnings almost always come out after the market is closed and after your options are no longer being traded in the open market. So a stock might gap down against you or gap up in your favor, but you cannot trade it. There's nothing that you can do to take an action with your options contract until the market opens again the next morning. This is after hours risk. It cannot be overstated. And honestly, this is probably one of the most dangerous things that there are in the options market. If you are selling credit spreads or multi-leg strategies, you very much could face a terrible situation where you have a sold put on Tesla and a long put on Tesla. The market closes and Tesla gaps down very far, say 20% move after hours. Your sold put contract is going entirely against you. You might have lost $50,000 in that moment. Luckily, you have a long put contract, the one that you bought as a protective leg. Thank God you have that, because that one just gained $48,000. So your net loss is only $2,000. That's what you expected. But if your counterparty exercises on you after the down move and you forget to call your broker or push the magic button to exercise your long leg, then that long leg could expire worthless because you didn't tell them. That only leaves you with the downside. You lost $50,000 on your short put, and your broker, which almost never happens, but it can happen, doesn't do anything with your long leg, and that thing expires worthless. So now you've kept only the downside of your short leg and you forgot to exercise your long leg to protect yourself. And it is the catastrophic loss that might be 20, 30, 40x what you ever would have imagined. And believe me, it sounds impossible. It's not impossible. If you look this up, and maybe we can put some links in the description, this has happened countless times. Do not hold short option trades on a Friday when earnings come out on a Friday. You need time the next day to adjust. If the options expire on the day of earnings, you are powerless. You better hope your broker does the right thing with your multi-leg strategy. So pay attention. Don't let this one happen to you. Don't hold short option trades on earnings on the day of expiration. You're just playing with fire. So what can you do to avoid all these risks? Well, it's just like anything else. You have to stay informed, you have to understand what those risks are, and you have to take some steps to avoid them. Having good risk management, like making sure you have protective puts or protective calls in case the option goes against you, is always a good idea. Keeping track of earnings events, binary events, Fed speak, geopolitical, macroeconomic news that are released from the various governments around the world is also unfortunately very important as well, because some unrelated press release might unfortunately impact your stock and therefore your stock option without you really realizing that was a possibility. You should always be monitoring the liquidity of your option contracts. Do not think that you can easily get in and out. Do not think that you're going to get a fill for the mid price. You absolutely will not. Keep track of the bid-ask spread. Keep track of open interest. Keep track of daily volume. If those numbers change, your pricing will be affected. You might want to get out before that happens. You might want to get out once your options move in the money, because you don't want to face those illiquidity challenges that you're going to face if the option moves very much in your favor or very much against you. Now, understanding all these risks and taking action to avoid them isn't some magic recipe for free, easy money. But not taking any action and not recognizing these risks is a surefire way to blow your account up. If you don't know what those risks are and you don't know how they work, you are absolutely setting yourself up for a very negative surprise. So take the time to watch this video or read more up on these types of option risks before you put your next trade on. If you found this content helpful or you learned something today, please like this video and subscribe to the channel so that we can continue to make more content like this. If you have any questions at all, leave them in the comment section below so I can personally answer them and help you on your option trading journey. Thank you so much for watching. This is Lucas from IntraAlpha, and I will see you on the next video.